Hello, everyone, and welcome to the complete tutorial on business tax planning. It is November 21st, 2022. I want to emphasize that because tax law does change, and I will have to give a 2.0 or maybe even begin to do this every year, but that is important. So, the things that we're talking about now pertain to what the tax law is as of that date, and subscribe to keep in touch to stay informed about things that might change. Okay, so I anticipate this to be a longer video, a longer tutorial, as I break down tax planning for businesses. There's a lot of information out there. This is a hot topic. Law has changed significantly over the years. And now there's TikTok. So now everyone is a tax planner. My name is Joe Gallegos. I'm a CPA here in Houston, Texas. I own my own CPA firm. I've had my own CPA firm since 2017. I've been a practicing CPA since 2012, but I began my first experience in public accounting in 2011 with KPMG there and their methods and credit services, also doing some federal tax. If you want to learn more about me and my firm, you can go to jackcpa.com. There I have more information about our purpose, resources, our services, and all of that. And I also have more videos on here that I hope that you check out because I think that they'll be really valuable. Let's get right into it, guys. Okay. So I'm sure you're going to love my design here. Elaborate artwork, as you can see. It's a joke. But what's most important is not how it looks, it's the information. And we're going to be getting into that. Okay. So let's start off first with some big misconceptions about tax planning. And I want to interject here that this is what I'm talking about is based upon what I think is most important, most valuable. The tax code is extensive, but I do think that you can break down the tax code, you can break down tax planning into a few key ideas, a key few points, and a key few strategies. So I work with small and mid-sized businesses. I'm not working with huge businesses. An ideal client, I mean, we have clients that make from 100,000 up to 30 million. Okay, that's the range. So that's what this is based upon. I think that it's practical, it's comprehensive, and I think that you're going to find some things that you'll be able to implement immediately. Okay, so let's get into it. Let's start with the tax planning misconceptions. The first one, how much deductions really save you? All right, hot topic. Do I buy this piece of equipment or not? That's low hanging fruit right there. I get that all the time, and I hear that all the time. So I always tell clients, well, do you need it? Do you need it? Because I'm going to demonstrate some math here, but you'll see that how much you think you're actually saving in taxes might be less than what it actually really is. All right. So let's think of a scenario. It's year end, you're about to have to pay some taxes, and you're looking for some ways to cut taxes. And you have an idea, should I buy a new truck? Should I buy a new piece of equipment? So the first question that I would ask if someone asked me that is, well, do you need it? Let's talk about the business purpose of this thing that you're about to buy, because I don't want tax to be the number one consideration, because it makes no sense to me to spend $1 to save 30 cents. That's what I always say. And let me explain that. So, how much are you saving when it's the year end and you're thinking about buying a piece of equipment to save taxes? How much are you actually saving? Okay, so let's do the math there. Some information that you need is what is your effective tax rate? You can get that from your tax return. Just look at your taxes, divide that by your taxable income. You get an effective tax rate. Let's say that is 30%. Now, let's say that you have $100,000 taxable income. So that means that the taxes that you are going to pay are $100,000 times 30%. $30,000 in taxes is a steep bill. Joe, what can I do to save taxes? Should I buy something? Okay, you want to buy something. Let's figure out how much you're going to save. So, using this same tax rate, let's say you can buy a piece of equipment that you can depreciate. It costs $50,000. All right. So, two ways to figure this out. How much am I actually saving? So, I'm spending $50,000. Now, you may finance it, so maybe you're not spending all that at once. And I'll try to talk about that point as well. But you're ultimately going to spend $50,000 one way or the other. Okay, whether you finance it or you pay cash, it costs you $50,000. So let's figure out two ways of what I'm saving. Let's do it this way: 100,000 minus 50,000, because I'm depreciating this. Let's say it's 100% depreciation. That means I get to write it off 100%. Now I'm writing it off 100%, so I had 100,000, but I'm taking this 50,000, so now I have $50,000. My tax rate is 30%. Okay, so it's $15,000. Let's cut my taxes 15,000. So I saved 15,000, but how much did I spend? Spent 50,000. I'm still net negative 35,000. Saved some money, but overall spent 35. Now there's a shortcut. I can just take the deduction and multiply it times the effective tax rate. 15. You're not saving 50, you're saving 15. How do I know what I'm saving? How much does the equipment cost? What is my effective tax rate? Or you can do this calculation here. So that's why I say, hey, why are you going to spend $1 to save 30 cents? That's what I mean. What I mean by that is you're not getting 100% of that benefit. If you're spending 50,000, you think I'm saving 50. You're not saving 50. You're actually net 35,000. If you just spent 50,000, you save 15,000. Maybe it makes you feel better that you didn't give that to Uncle Sam, but at the end of the day, you're still down 35. So what was the better situation? Well, if you needed it, great. Now that equipment didn't cost me 50,000. It cost me 50,000 less the 15 because I saved some money. Awesome. But if you didn't need it, and if it was just you're just doing it for tax purposes, as you can see, you do not end up in a better place. So that is a misconception that I want to bring up. Second misconception. Now, I see a lot of marketing around this, a lot of campaigns. This is how people like to irritate people, get people mad. Like, hey, there are people out there who are not paying taxes. Why are you paying taxes? Here's the truth. You're missing a piece of information. Now, can we go and find big corporations that haven't paid a lot of federal tax? Absolutely. But the question is, why aren't they? And will they eventually pay taxes? And a lot of times, I'm just going to point out the reason for this misconception is that a lot of times that this is a timing issue. So, for example, right now, we have 100% bonus depreciation, meaning that you buy a piece of equipment, you can write off 100% of it. And so a corporation goes out, they go buy, they make a lot of capital expenditures, buy a lot of equipment that they can depreciate, they get to deduct that. A lot of these companies are going to front end their capital expenditures because of this incentive that the government is giving them, that if you buy this equipment, you get right off 100% of it. But it's just a one-time benefit. So over time, that benefit will reverse and they'll eventually pay taxes. Because like the example that I just showed, yeah, there is a benefit. There's a real tax benefit, but are they in a better place for spending that money? It would have benefited them to not spend that money, just pay the taxes and pocket it. It's just math. So everyone pays taxes at some point. And if they're not paying taxes, here's a rule of thumb. You're missing a piece of information, so you don't have the whole picture, like I just said. It's illegal or it's cheating. And there's plenty of that. There's plenty of that around. My last point was TikTok. It's garbage. Check these people's credentials. Are they CPAs? Are they NEA? Have they been practicing? Or are they just remarketing something that someone has told them? Okay, so check their credentials. This is taxes that we're talking about. We're dealing with the IRS here. You don't want to play around with them. Which brings me to my second point. So why is tax planning important? The first point I have here is planning for the future. Taxes, when you're a business, are a big portion of your profit. If your tax rate's 25, 30, 35%, you're paying that from your profit. It's a big part. You can think about the IRS almost as a partner, as a silent partner, and they have an interest in your profits. Now, here's the thing. Show an example. I'll open up an Excel here. Where can I get an Excel? All right, here we go. Okay. Planning for the future. All right. Tax law changes. Now, we know some things are going to sunset. Depending on your entity type, we got some things as part of the Tax Cuts and Jobs Act that came out. I believe it was 2017. Those things are going to start sunsetting here. Some benefits are going to start phasing out. For example, bonus depreciation is going to begin to phase out next year to 80%. But Section 199A, which is a 20% deduction, that's going to begin to phase out. So there's a lot of things that are phased out. Now, when we talk about the future, whether that's I want to buy a new home, I want to move, I got to pay for my kids in college and those things. And knowing that taxes are a big part of the costs that you incur every year, you need to know what that's going to be in order to plan. Because if you're planning on buying a new home next year based upon what your after-tax cash flow is this year, and you're not considering what it's going to be for those upcoming years, you're going to be in trouble. Because just think about it. Maybe your after-tax cash flow is higher this year because you took a bunch of depreciation. Maybe it's higher this year because you utilized some tax deductions that are going to begin to phase out. You can't plan for the future without at least trying to assess where taxes are. Because let's say for example, purposes, Bob makes $100,000 a year. After expenses, he's taking home, say personal expenses, mortgage, all of that. Let's say taxes are 15,000. Say his personal budget, he spends about 70,000. The total is 85, 15,000. Let's say he starts to think that he can afford a new home based upon this budget, but doesn't look that, hey, this was actually really low because of that 100,000. He bought an equipment worth 50,000, so it lowered that down, and he had a temporary benefit that year. But let's say next year comes, you don't have that depreciation anymore. Let's say those taxes are now 25,000 for whatever reason. Hey, this stays the state that stays the same. I don't have 15,000. He has 5,000. That's simply because of what happened with his taxes. So you can see as that it's important. I have a family of 4, married. There's a lot of planning. There's a lot of budgeting, and I have to assess where taxes are going to be. Okay. Another thing why tax planning is important. Tax law does not treat everyone the same. We know that. Tax law is passed by Congress, and Congress wants to reward certain activities. So if you know what those activities are, then you can plan for them. If you know that they want to reward investing in an opportunity zone, then you can plan for that. If you know they want you to save more, you can plan for that. So you want to think about what is Congress trying to accomplish here and how do I utilize that? Okay. So now we're going to go into what I think are the biggest opportunities when it comes to tax planning for business. I got 4, and then I'm going to end with how do you assess for opportunities? How do you do this for yourself? And then I'll provide some resources as well for you to do that. Again, this is practical. This is anecdotal. Maybe you've talked to someone and they're giving you some elaborate scheme. It's probably rubbish if you got it from TikTok. But this right here covers 89% of actually what I do. This is actually how I help people. So yes, there's maybe a percentage that I'm going to neglect here. I'm not going to talk about, but this is going to cover 80, 90%. Someone calls me, Joe, hey, can you help me? Can you help me do some tax planning? What can I do? I'll bring this up right here. All right. First step, entity selection. Now, you have ability. Most people file as an LLC. So as an LLC, you got a couple of options. If you have more than one owner, you be taxed as a partnership. You can be taxed as a C corp if you have less than one owner. You be taxed as an S corporation if you have one. You can be one owner, or you can have multiple owners, or you can just be taxed as a single member LLC filing a Schedule C. So, as you can see, there are options, and how you choose to be taxed will impact how much you pay in taxes. All right. So what do I need to do? Well, you have to factor in everything. Now, this focus here is just on taxes. I wouldn't go make selections without first thinking about the other considerations. For example, sometimes we get people and they're starting a business and they eventually plan on getting investors. And so that's going to factor in what we're going to recommend to do. But then sometimes you get people and just say, hey, it's just me. What do I need to be taxed on? Okay. So there's other ramifications. I'll caveat that. But this focuses on taxes. And I'm going to walk through that. Okay. So I'm going to just illustrate some stuff first. Get paint out. Okay. You make money. This is profit. I need to pay myself. How do I get paid? Default one. Say this is LLC, single member LLC. Single. I get paid. Make 100,000. Profit. How that's reported to you, whether you distribute it or not, is taxable. Now there's two layers to this. You have Fed tax, and then you have FICA. That's Social Security and Medicare. Now this can range up to 37%. This is total 15.3 because you are the employer and the employee. Okay. So just simple math, I'm going to pay about, if I was at 30, so that's kind of high. Let's say 20, 25%, just make it more practical. I'm going to pay 25,000 in federal taxes. I'm going to pay 15.3 in FICA, about 15,300. Okay. That's default. Excuse me. You got to sneeze. All right, I'm good. We're live here. Now, let's say you decided to instead file as an S corp. Now you have two options on how this 100,000. I made 100,000. How am I going to distribute that to myself? How am I going to pay myself? Well, let's see if I can erase this. Need a bigger one. Well, now I have some options. So now let's just say this is an S corp. I can pay, let's say I pay 50K as a salary. So now my income is now 50. I'm still going to pay the 100,000, right? I'm just now recharacterizing how I'm getting paid. So 50 now is income. 50 now is W-2. Now this W-2, what is applicable? Paying the 15.3 effectively. I'm going to get a deduction for the part that I'm paying that is my employer contribution, but just to be simple. And then I'm paying a tax rate here. So that's totality there. On this part, I'm only paying this percentage here. So that's roughly what, 70, around 7,500, right? If it was 15,300 at 100,000, now I'm paying a little bit, around 7,500 here. And over here, I'm not having to pay that. So I basically cut my FICA in half by half. So as you can see, entity selection has a big deal. Now, I made this really easy. I've gotten this resource from over the years. I've just consolidated a bunch of resources, and this is going to be available to you. It's loading. All right. So we got some data input. See the example that we had. So we have 100,000. This tool is to help you figure out what entity is best for you. I will say that if there's more than one entity, more than one owner, you think about it. And then also if there's more than one entity as well. Say it's 50,000. Make this 0. Now again, the example that I gave was very plain and vanilla. There's obviously other parts in here, section 199A, deductions like that. At the end of the day, I just need to figure out what I need to get paid. Now this is So basically, to make this the example that I would, you want to, these two numbers, you want to be your total income. So if I make 100,000, I'm going to split between the two. That's what I'm going to do. If you put that this is 100 and that's 50, it's going to show you're making 150. Okay. Now let's just go through these examples. Here's that self-employment tax. It's reduced. It's less than the number that we were talking about because it's reduced. Let's see how this is being calculated. Okay. So here goes that for this situation, the first situation, right? 100,000. Here's a 1999A that I did not consider, but this does consider. It's 20% of your net income. Fed tax. Well, this is reduced by the 199A, so it's less than the example that I was given because I wasn't factoring that in. Here's the 15.3, you get deduction. So total around 33K. It's roughly around the number that we were talking about. But here as an S Corp, get the deduction. Here's the amount that I'm paying from the FICA, but then I also have this other portion here because I'm also the employer. Here's the employee portion, the employer. So it's roughly, if you look, these numbers here, like I said, it gets cut in half. It's about half of this number. That's what you save. Still got to pay the federal tax, but I get to deduct my salary. I also get to deduct the 199A. And so best option right here, saving roughly about 4,000. And this basically gives you the optimizer. And assuming that it is available, it might not be available to you. Obviously, if you have less than one owner, this is not available. This is if you're an LLC, you can elect to check the box to become a C Corp. And these three would be applicable because you'd be an LLC, be taxed as, effectively, these are basically the same. And then S Corporation and LLC can be taxed as an S Corporation. Okay. So that is step one of tax planning. Someone comes in, hey, what entity are you? Are you the best entity? And if not, what can I do? So if you're an LLC, there are late election reliefs. You can file underneath those. I do have a resource if you're an LLC that needs to make a late S election relief. I'll show you that at the end, but I do have a resource to help you with that if you need to make that election. But as you can see, it's a high leverage item. Someone comes in, they're a sole proprietor, no other owners. That's low hanging fruit right there. We could probably help them. Okay. Next thing that I'm looking at. Do I need to make some method changes? And I highlighted the big ones here. Cash versus accrual. I get a tax return. Are you on the cash method or are you on the accrual method? What's the difference? The difference is cash, I'm getting taxed on what I got. What someone paid me and what I paid out. Accrual, I'm getting paid on what's been incurred, what I billed but not necessarily collected, and bills that I've received but not necessarily paid. Which one is going to be the best for you? In most circumstances, it's the cash. I want to be taxed on the cash basis. Most circumstances, but in some cases, it's not. All right. And the differences can be wide. I was tempted to go into an example on that, but I want to stick to tax. Just know that those basic principles. I'll make another video that's focused exclusively on the cash and the accrual methods and why they're different. But those are your options. You have options. If you're a business that's over 25 million, you don't have options, as many options. If you're under 25 million, which is in the world that I operate in, you have options. A big method also is inventory. So if I'm under 25 million, how can I account for inventory? There are methods that allow you to treat inventory as a period cost, meaning instead of capitalizing them, putting them on my balance sheet, I can deduct them as I pay for that. These are two items that I look at. What's the method change that we have available based upon what they are? And there's big differences, big swings going from cash to accrual and accrual to cash and inventory. If I get a small business, they come and I see inventory on their balance sheet, I know that's an opportunity. And I'm going to talk because the last section I have here is assessing for opportunities. I'm going to talk about what I look for and what you can look for on your tax return to see if there's any opportunities for you. The third option, deductions. Draw another picture here. When you own your own business, here's what happens. There are areas that are clearly business. There are deductions that are clearly business and therefore clearly deductible, and you have no question whether they're deductible or not. Then you have expenses that are clearly personal. They have nothing to do with your business. But then you have this area right here that has some crossover. So I'm going to talk about some of the main ones. I'm going to provide this list of that's pretty comprehensive of all the deductions you can get. But I'm going to talk about the main ones, which include home office. Here's the thing about a home office. A lot of people don't take it. Say it's a big red flag. It's in the tax code. You can take it. Travel, meals. I'll talk about the big one, hiring children, and depreciation. So, I'm sure you've heard about hiring children and the benefit for that. I think it could be very good if you have kids that are of age that can work. It could be good. It's not very good if depending on the entity type. Okay, so if you're an S corp or a C corp and you pay your kids out, you have to pay FICA. If it's a single member LLC that you're paying your kids out because they have an exemption of up to $12,000. So if they're doing something for your business, you can pay them. If you do that and you're a single member LLC, you don't got to pay FICA. It's a great benefit. Any other organizational type, partnerships also fall into that bucket. S corps and C corps, you got to pay FICA. So in that case, depending on the circumstances, it may be good, it may not be good. It may not save you anything at the end of the day. It just depends on your entity type. Now, you can't have a multi-entity type. You can't have a situation where, you have so for example, we have more than one business in our family. So we have entity here, And then we have my wife's entity here. And there's sometimes that we have expenses that might relate to both. And so we have an entity in the middle that we run those expenses through and then we reimburse. And I just show that to say that, and this is a single LLC, sole prop, that there are other things that you need to think about when you're thinking about the situation. Okay. Now, here's also the big thing with deductions. I'm not going to get too much into everything because I'm going to give you a list that's going to have very comprehensive of everything that's available to you. But the thing to think about is not about, remember, first example, it's not about spending $1 to save 30 cents. In the case when it comes to deductions, it's what am I spending now that I may have over here, or maybe it's over here and it's not hitting here, that I can take advantage of? Is there an IRS rule? Is there something that I can do differently? And the best way to do that is to scrub your financials, scrub your personal statements, look for big items, do a personal budget. What are some big items that I'm spending that I know that are coming out? Is there a way that I can get a tax benefit from this? Health costs is a big one. It's a big one. Kids are a big one, especially if they're going to a school or a private school. How can you get them to work? You're already spending, that money's going out anyway. How can you get a benefit for that? That's the way to think. But I'm going to give a resource on deductions for you that can help with that. So we talked about entity selection, method changes, deductions. The last one is retirement. I'm not going to spend too much time on this. There's a section in the list that I'm going to give you that follows all the options that are available to you. But the IRS obviously wants people to save. Now, when it comes to this option, here's the thing that you got to think about. How much can you afford to put up? Someone comes to me and they say, hey, I need some help on tax planning. Okay, what are we working with? And what I mean by that is, let's say we've checked the box on entity. We've checked the box on method changes. We've checked the box on deductions. What do we got left? Retirement. But this involves putting money away that's going to restrict that money for a certain period of time. So if you don't have your personal budget, that's why your personal budget is important. I have another video that talks about how much I should be getting paid from my business and why it's important. If you don't got any more money that you can work with, basically money you're being taxed on but not utilizing in some way, then this right here might be irrelevant because you can't even afford to put money away. But if you have some gap, which I see a lot with doctors, professionals, any business owner that's making more money and they're maintaining a pretty good lifestyle balance by living off of a salary or a fixed income from their business, and they have some extra money they can put away, this might be an option for you, which is, what can I do? What can I put away, generate a tax benefit for myself, so not get taxed on it, and grow this money. All right, we're going to conclude here. Assessing for opportunities. So what do I look at when someone comes to me and they need tax planning? So one, I request a tax return. And what am I looking at? Looking at their entity type. What are they being taxed on? What can they be taxed on? What are some other things that I need to be thinking about? And what entity structure gives them the best option? There's a business entity optimizer that I'm providing that you can have, that you can play with. If you have any questions, ask me. Be happy to answer. Another thing that I do is personal statement scrub. So again, that is the deductions part of the aspect. What am I spending? How much am I getting out? Ideally, what you want to get, if you're spending $70,000 on your personal statements out, that's money coming out. The IRS is giving you a standard deduction over $25,000 if you're married. but you're being taxed on the rest. So how can I figure out, is there a way, or are some of these related to business? I'm just not thinking about it in the right way. That's a hard thing that I got to talk about. People, when they come in, they just started their business, they have a vehicle. Hey, you're using that vehicle for business now. If you're using it more than 50%, you can deduct that. Well, it's not under the business name. That's okay. Things like that. So what am I spending? And you do that by looking at your personal statements, finding some categories and areas that are money coming out. And then what you do is you're going to pull up this comprehensive list that you're going to have access to and see if they fall into any of these categories. Next thing, cash versus accrual. I talked about that. Method changes. You can look on your tax return. There should be a check the box. Now, I will caveat that a lot of times that box does not reflect the reality. So I get a lot of business owners that come in and they have a one box checks and says that they're accrual, but they're actually filing cash. Happens a lot, more than you would think. Look at that. And then how can you change that? So this depends. If you've been a cash for 1 year or whatever method, if you're cash for 1 year or accrual for 1 year, you can amend that return and file it on the second year's cash versus accrual. If you've been doing it for more than 2 years and you need to file a method change, and that's via 3115, I'm not gonna lie, you're probably gonna need a professional to do that, and maybe I can do a video on that, but you have to file a method change if you've done it for more than 2 years. And then here's a balance sheet approach. I took a snippet. There's no names here. So what I'm looking at balance sheet is, what are my balances here? Okay, I got balances here. I got balances here. That's land, not applicable. Maybe I need to look at that. Maybe they have something classified as land that's not land. Other assets, what's there? What I'm looking at here is, how can I bring the tax bases of these down? So example, I got a net basis left of $723,000. Is there a way that I can accelerate deductions here by taking more deduction? Maybe it's cost segregation. Maybe I go back and file a method change to claim bonus. That's what I'm looking at. If I had inventories here, let's say I had inventories of 100,000. Is there a way that I can deduct all of that? And then AR. So I'm thinking accrual to cash. What's the difference between here? Wow, that's a big difference. 400, 500,000 right there. Is there a way that I can defer that? So look at your balance sheet, look how much assets that you have on that, and see if there's a way that you can accelerate the cost recovery of those to get a benefit quicker. Now, resources. I got resources for you. Go to jackcpa.com. Free tools. Business tax planning tools. So here's the business entity selector that I talked to you about. This self-rental agreement is related to the Augusta tax planning deduction. I didn't go into that into detail. That may need a whole video by itself. I'm live now. Let me turn off my phone real quick. Here's an ebook that elaborates on deductions for you. Some of these things that I've been talking about goes into more detail. Here's the late S election. This is an example of what you need to attach to the form 2553. Here's a tax strategies list. So you're going to get this list right here. It's going to have all these things. This is a resource that I've gotten in my record. So I just want to provide it to you for free. You can have it as well. And then a business tax estimate. That requires a separate video all about business tax estimates. You click on it. You're going to go here. You're going to have to provide your email, but you can unsubscribe if you don't want it. You don't want me to email you. It's fine. And you'll get all the tools. And you have any issues with that, email me, joe@jackcpa.com. jackcpa.com is really easy to remember, and happy to help you. All right, guys. Have a good one.